Okay, we're going to get started by looking at the S&P 500 like we usually do. You can see that the S&P, the SPY, is below all moving averages. Um, we went through the 200-day moving average, and since then, we've been kind of going up just a little bit. You can see in our stochastics that we're at 33. That's oversold, and we're going up. You can One thing you'll notice is that the 200-day moving average, after we broke through it, is going to be the resistance. It was support up until this second, and now we're going to, every time we go to that line, that 200-day moving average, it's going to be resistance. So keep that in mind. All right, and let's look at um, the lines that we're drawing here. We had an uptrend for since 2003, multiple years. It was broken right around at the end of March, right now. It was broken right there. And we have a downtrend, and that we're basically in the process of deciding whether we're going in an little uptrend here or continuing our downtrend. We have a lot of indications that in general, the economy is slowing and the large cap stocks in the US stock market are overvalued. So we're like at a decision time in the stock market. So we'll see what happens in the coming week. Let's look at our meeting notes. Okay, so where we just went through a triple witching, and I marked every triple witching day with red. So you can see it's every couple months. So we have a 23rd of March, we have June 20th, we have September 19th. Triple witching is when a large amount of options expire on the same day. So there's people that are buying put contracts or call contracts, and they got to basically settle those contracts either the 21st or 22nd. So because of that, there's a certain amount of volatility, and you got to expect that. And you have to take the volatility on these days with a grain of salt. Okay, we had a Fed meeting this week. They decided not to raise interest rates or reduce them. And so what we have right now, we have end of quarter window dressing that's coming up. We're going into one of the best months of the year. So you can see from our average monthly stock market returns, April is the best month of the year. And it has a 1.51 average return. So we've had a pretty bad month so far in February, no, in March. So we do have earnings coming up. So in a couple of weeks, we're going to have the big banks restarting their reporting. We have JP Morgan in the second week of April. Um, then we have the big tech stocks, starting with Google and Amazon, Apple, Microsoft. So that could be a good reason why stocks could start going up because earnings a lot of times helps stocks and it hurts them too sometimes. So we'll see what happens then. Um, what else do we have? All right, that was a good thing to go over. Okay, so since last week, we've had U.S. Treasuries going down 2% and 10-year and 2-year down around 2%. So you can see here's the chart of the S&P 500 versus the yield of the 10-year. You can see there basically a one-to-one correlation now. You can see that as the U.S. 10-year goes down in yield, the S&P is going down. And that means the bond market is smarter than the stock market. Bond market thinks that there's going to be a slowdown in the economy. And when there's a slowdown in the economy, um, investors will reach towards safer investments, such as the 10-year. And so the 10-year goes down whenever the economy in the US is slowing. So that seems like what's happening now. Okay, what else can we see? We can see that there is no momentum in the stock market. We have 33% of the S&P stocks are above the 50-day moving average, 41% above the 200-day moving average. Okay, so we're losing momentum. We have um, a slowdown in the economy. It looks like the growth stocks from last year are moving into a sideways pattern. So if you see, let's look at some of our charts for the stocks that we're watching. Okay, so the drug stocks that we're watching, they're pretty much they're most of them are in an uptrend. So we have AbbVie, we have Abbott Labs, and you have let me see, let's look at some more examples. Um, so look at Apple. Apple is like in a sideways trading range, and it looks like a lot of stocks this year, because the economy is slowing, we're going to have pretty much a sideways, not necessarily an uptrend for a lot of the stocks that are overvalued. So we've been saying that Apple is only growing maybe 10 or 11% a year or less. So, and their PE is around 30. So it's almost three times overvalued. So it's going to take a while for Apple to catch up to its valuation. So let's look at, okay, we're done looking at that. Okay, so let's look at, okay, some more talking points. So we don't have a whole lot of momentum. Our revert to the mean where healthcare, telecom, financials, energy, and utilities, which have done worse, the worst in the past couple years, have started to outperform. Um, and we see the S&P 24 at the beginning of the year. Now it's around 23 or 22. So over time, it'll revert to 15. What else? We have an amazing amount of uncertainty in the market right now, and people pay less for stocks in their multiples when there is uncertainty. We have April 2nd. Let's look at our calendar. April 2nd, we have tariffs that might, reciprocal tariffs that might go through. I think what's really going to happen is there's going to be a lot of negotiation and not necessarily a one-for-one reciprocal tariff. Like if it does go through, there is um, a lot of uncertainty of whether the corporations of America will make the same much money as they did before. So it's an amazing amount of uncertainty, and along with the job cuts by Doge, it seems like it's not going to be a steady path for the rest of the year. So we really don't know if the stock market's going to do good or bad this year. We just have to wait to see what happens April 2nd. All right. So what else can we see? Okay, let's look at the major variables of the stock market. The price of oil, WTI crude oil is $68 a barrel. That's pretty low. Yeah, it's a little bit more than last week, and it's probably pricing in a global recession or some kind of global slowing. So as if the United States puts on a bunch of tariffs to other countries, it seems like their countries' um, economies are going to slow around the world. So it seems like the price of oil could go down because of that. Um, the inflation rate is currently around 2.8%, so it's going down a little bit from last week. And the dollar index is unchanged, but it is going down. You see, you can see that the dollar has been going down. That's going to help the big tech companies this quarter. You can see that it's down almost 4 or 5% this year. So whenever the major tech stocks report, they're going to say that the dollar helped them, the exchange rates. So dollar down will help emerging markets. And so, for instance, if um, there's a company, there's companies doing business overseas, or if there's other countries like in European countries that do business with America, and the dollar is going down, that helps the foreign countries. Okay, let's look at the fear and greed index. Fear and greed index is still extreme fear. It's a little less than last week, but we still have extreme fear. The translation as a contrary investor is you got to buy, hold your nose and buy, but don't sell. Um, so Warren Buffett once said, you have to be fearful when others are greedy, and you have to be greedy when other people are fearful. So let's look at the AAII survey. And again, we have a bearish reading. So this is what the ninth in a row bearish reading. That is the most since probably the financial crisis. So even though we're only down 10% in the S&P, we have capitulation sentiment in the amateur investor. That's a contrary indicator. That's usually a sign that it's time to buy rather than to sell. Um, okay. Okay, so right now the VIX, it's a little less fearful than last week. It's 21. That's implying a 1 to 1.25% move in the stock market on a daily basis. So that is we've had a lot of movements in the stock market in the past month, probably negative for the Nasdaq or the tech stocks. So we have fear in the market, and in this past Friday, we've had a lot of put buying that where it was expiring. So we had a lot of forced buying. Maybe that's why the stock market went up on Friday. All right, let's look at our emotional graph. So right now we have fear, extreme fear in the market. And we don't have capitulation yet, but we have extreme fear. We have an unknown for tariffs and for trade war. We don't know what's going to happen. And as soon as that's resolved April 2nd, we might exit the fear, extreme fear, and go more towards a neutral stance. I don't know. Um, what else do we have here? Okay, so as soon as some of these reciprocal tariffs um, resolve themselves, so this tariffs that could cause some kind of crash. We could have a global depression if the tariffs affect other economies really poorly. We start off with a little correction in the Mag 7 stocks, the highest capitalized stocks in America. And if they can go down some more, we might have a lack of confidence in them, and they might gravitate towards a PE of 15 or so, which is average. And that's like half the price they are now. All right. All right. Let's look at, okay, here's a graph from DoubleLine. They basically listed the percentile for each of the different types of investments. We have US equities here, we have non-US equities here, and fixed income there. So what they're saying here is the US equities are at like over 90 percentile. meaning they're overvalued compared to normal times. And then that's the for a lot of these metrics. You have the forward PE, you have the trailing PE, price to sales. So all these metrics to measure, how good they are, how overvalued they are, they're pretty much overvalued. And you compare that to non-US equities, and they are basically trading at a 70 percentile or less. So that means they're better they're better priced and have a better value. And you can see that these are fixed income, and they're at the lower end of the valuation range, meaning they're they are cheap compared to history. And so if we look at this chart and then look at the next chart, the performance of these assets year to date, you can see that um, the U.S. stocks are underperforming in a major way. They're down 5 to 10%, whereas let me see, the Euro stocks and foreign companies are doing really good. And the U.S. Treasuries 10-year, you have, the positive returns for a lot of the fixed income. So what this is basically saying is that the undervalued sectors of the world and investing universe are outperforming the sectors that are overvalued, such as the America stock market. Okay, so I guess um, that's a good lesson to learn for diversification because these sectors that have underperformed for the last 10 years, a lot of investors have ignored them, and now they're starting to outperform the US stocks. Okay, so let's look at the worst to first. We've gone through from the beginning of the year. So the worst performing sectors from last year: real estate, healthcare, energy, consumer staples, materials. It seemed impossible for them to do better than the ones that have been doing the best since for the past couple of years. But you can see that they are outperforming. We have energy up the most, healthcare up 6%, and we have financials up 2%, utilities up 3%. So the worst have indeed turned around and became the first. You can see that the healthcare, energy, consumer staples, utilities have done bad 2 years in a row for 24 and 25. So they are outperforming this year. Um, and okay, so our rationale from the beginning of the year, where investors are going to be reaching for stability amid chaos. So the chaos continues. We don't know about the tariff situation. We don't know um, how other countries are going to demand the products from America that they used to after the tariffs. Um, so a lot of times we have to look for safety in uncertain times. So utilities, healthcare, and consumer staples were our ideas from the beginning of the year. So we have a weak dollar now. So as the dollar gets weaker, we have companies overseas will be positively affected. We have the tech stocks from America, any stocks that are doing business overseas, they're going to have maybe 3% better earnings than they normally would due to the dollar. And and the price of commodities, oil and gold, will go up. So that I guess that let me see. All right. So that was a good review. And let's look at some of the stocks going up and down today. All right, so we have a lot of these stocks are AI data center oriented. We have Supermicro. Um, they make data center systems. We have Tesla. We have Palantir. They do software for AI. Dollar Tree. That's interesting. Dollar Tree is up today because of they get most of their products from China, and they're going to have a big tariff problem. Boeing is a contrary stock that they've been going down for multiple years. Boeing just had some news that they might get some business for their defense part of their business. So Boeing actually got a contract with the government for fighter jet technology. So they might be making the next version of fighter jets for the U.S. government. And okay, let's look at the ones going down the most. We have Micron. They just reported their earnings Thursday, so that could be from that report. We have Texas Pacific Land Corp, Lockheed Martin. They're down because whenever Boeing got that contract for the next fighter jet, Lockheed Martin lost that contract. So perhaps Lockheed's not going to be able to get money for the fighter jets that they're making. And let's look at what else is down. We have Nike. It continues to go down. We started looking at Nike in the hundreds, and they were super pricey. Let's look at Nike right now just to see what its peg ratio is. It's probably still a little bit overvalued. So Nike's biggest problem is they have a lot of inventory and they're trying to reduce their prices to get rid of their inventory. And on top of all that, they're going to have problems with tariffs. Let's look at their statistics. They went down 5%. Wow. Okay, this is a 5-year chart of Nike. That is like one of the worst charts I have ever seen. So it is in a downtrend and it isn't breaking out of it. This is a stock that Bill Ackman bought recently, and we looked at it. Their peg ratio is 5. Okay, so if their forward PE is 28, Yahoo Finance thinks they're only growing at 5%. So that is not a growth stock. So they have a new CEO, I know, and they're trying to they have a lot of competition from new sneaker companies like there's Decker, which makes UGG and ONN. There's a lot of new competition, and Nike isn't keeping up with newer trends. They're probably they probably need some new types of shoes to get people excited. Um, they're relying a lot on the Jordan brand, I think. So it's really overvalued. It's still, as it's going down for 5 years, it's a peg ratio of 5. That means it's 5 times overvalued. The real value is probably 11. So I would stay far away from this one. Okay, let's look at what else is going on. Okay, so we can see from our chart, let's look. Okay, this is a 10-year. You can see it's going down. So we expect from our cheat sheet, the 10-year is going down. Okay, positive for small caps, stocks that are heavily indebted and because the cost of refinance, it, goes down. High yielding stocks are going to be going up because of utilities, because if the 10-year yield goes down, then investors will be reaching for high yielding investments. Home builders should be doing better because houses are more affordable as interest rates goes down. Let's see if that matches today's. No, it doesn't. The home construction ETF is going down, and metals and mining, gold miners going down, and yeah, another home builders. I wonder why the home builders. Let's look at the current 10-year. Okay, well, I guess the 10-year is going up just a little bit. Okay, so okay, I expected as the interest rates go down, that would help the home construction companies, but it didn't. Let's look at the ones that did the best. Biotech, consumer discretionary, technology. This all could be related to the triple witching time because there's a lot of contracts for the tech stocks in in the options market. So, okay, that's surprising. So, I guess we can't get much from that. All right, let's look at Dan Now's picks from the beginning of the year. He had ADTN. They do networking for the AI data center, and they're up 10%. Cisco is only up 2%. IJJ, the mid cap ETF, they're down 4%. And KWeb, KBWB, they are down 3%. They are the big bank ETF. Cash is yielding 4%. That's probably his best pick for this year. So I wonder when he's going to start deploying his cash. Probably when everyone's selling. Let's okay, we know that the government is scaling down and firing people and reducing a lot of the programs and spend of the government. Um, this is there's a lot of uncertainty that's happening because of this. We're going to go over a little bit, a person who's monitoring this right now, and see what he says. Let's hold on. Let's look at, here it is. The big short investor who predicted the 2008 crash warns the stock market is underestimating the economic impact of Doge's mass spending cuts. Okay, so this guy that Danny Moses, he was one of the investors that predicted the 2008 crash. He sees a similar situation here. He says that the stock market is currently overvalued at 23 times PE. We've been saying that for a while, and he is right now. He thinks the stock market will go down because um, he says the tariffs that are being talked about are going to hurt the revenue side of the U.S. corporations. He says we are too optimistic how this is going to play out. If you go back in the 1920s, the uh, the United States put on huge tariffs. I think it was a hoot. Um, I forget the name of the tariffs, but there was tariffs that were put on right before the Great Depression, and that could really disrupt the global economy, maybe to a point of a recession or a global depression. There's a lot of participants in the stock market that think that Trump is going to pull back from his threats and make negotiations with every one of these countries. But it certainly could slow down the economy and hurt the revenue of the companies. So we're going to keep this in mind and see if there's any evidence every week to see if there is a lack of confidence and, you know, if these tariffs do go through, we got to keep our eyes open to see if there is a slowdown in a major way across the world. Okay, So we're going to go over a couple major stocks just because if we do have a sell-off in the stock market, you got to know what to do, and you have to monitor and see what the values of stocks are as they fall. So it's always good to get comfortable with the valuations of some of the major stocks in the stock market. We're going to check out NVIDIA again because we just had a global, we had the earnings reports come out, and it takes a week or two for the estimates to go into the system. So we see from this, we have a 51% growth between this year and next year. And then we have a 28% growth for the next year, 13 and 5. So when we looked at the video last year, they didn't have 51% growth for this year. We had less. And we for this year, we don't know if these analysts are accurate, but we're assuming that they're growing at 51%. And their forward PE is 26. So that means their PEG ratio right now is 0.5. So they're about half price. Their fair value is around 240 according to that little formula. Let's look at um, let's look at what Morningstar and CFRA say. So Morningstar says their fair value is 130. So they think they're undervalued by maybe 15%. And let's look at what CFRA says. They said that their fair valuation is 110, which is right maybe 6 or 7% higher. So they're 6 or 7% overvalued right now. But they think we think the product roadmap, along with its new software platform and announcements in the robotics, positions well for growing AI compute demand. So they have a buy on it with a target of 165. So I think CFRA has a really good understanding. I follow them a lot. And so they think they're fairly valued. Let's look at let me see, they threw out a note here. Um, they think their product roadmap along with its new, yeah, we already said that. Okay, let's look at the performance of some of the stocks we're watching so far this year. You can see the top performing stocks have in common, most of them are drug or phone or dividend oriented stocks. And we have Amgen, drug, AT&T, they're a dividend paying telecom company, and AbbVie, they're a drug company. We have T-Mobile, a telecom company. Berkshire Hathaway, it's up 15%. This is an example of a stock that almost all of their sales are in America. They're kind of protected from tariffs because most of their money they make is from within America. And on top of that, they have $325 billion in cash. They're waiting for a crash. So they would be one of the best beneficiaries of a crash in a correction in the stock market. Um, J&J, they're a drug company. Gold is up 13%, and Waste Management is up 12%. And Abbott Labs, they are a drug company, and Altria, they're up 10%. So they pay a dividend. So as interest rates are going down, you're going to have the dividend paying and conservative stocks um, higher in demand. All right, let's look at okay, we said at the beginning of the year, the theme for this year is chaos is coming. So we have to be ready for any kind of chaos that happens. And it's like you're playing a game like a baseball. Whenever the ball is hit to you, you have to know where to throw it and what to do. So we always plan for that. Let's look at some of the charts that are, we already looked at Apple. Apple's in a sideways pattern. It goes between like 200 and 240. And it looks like it's going to be doing that for the rest of the summer because it's basically overvalued right now and um, by 3 times. So it's going to be really hard for it to go up anymore until it has earnings that can help it. Let's look at Meta. Meta is in an uptrend. I have this since this is a 1 year chart. You can see that it's still above its 200-day moving average, and it is one of the strongest stocks in the market. You can see it went up a lot this year, um, like 20%. This was like what, 20 days in a row that it went up, but it's still within its channel. It's one of the stocks that is a beneficiary of the AI trade. It's oversold and it's holding really good at its moving averages and its channel lines. It's one of the only tech stocks that's really still has momentum. Okay, Visa, look at this. Um, it's oversold and it's still in an uptrend. The great thing about Visa is they're a toll collector and um, they make money and they don't take a whole lot of risk. Um, whenever whenever someone declares a bankruptcy, the bank actually manages that, and but Visa still gets, a little amount for every charge in its network. The one problem with Visa and MasterCard is if we go into a global recession, there's going to be less spending, and also they have less tolls to collect for the money coming around in the world. Another problem is that the government just canceled a lot of credit cards. So there's going to be less credit card spending from the government. That might affect, in a small way, the credit card companies. Okay, you can see Walmart. Um, it seemed like it was in an uptrend forever, but it actually is down to 85. So it's down around 10% from its all-time high. But just thinking, they have a lot of their goods come from China. So they're going to have to adapt in a major way to the new tariff situation. They tried to negotiate individually with Chinese companies to get a discount, and they got in trouble from the Chinese government. So it's going to be very challenging. Maybe that's why they're starting to go down a little bit here. So maybe after April 2nd, whenever the tariff situation is more clear, this will have a chance to go up and resume its uptrend. Let's look at Berkshire Hathaway. You can see how it's one of the only super outperforming stocks in an uptrend. They were selling off a major portion of their stock portfolio last year when everyone else was buying, and and they're in a they're not affected by tariffs because they're an American-based company. So they are doing really good here. And I guess the best time to buy this stock is whenever it's at the bottom end of its channel, which is like right here, and right here. Okay. So, but this is like a safe stock right now for this type of environment. And this is MasterCard. Very similar to Visa. It's holding its uptrend here. They take a toll for every transaction in their network. So they have very little risk for the consumer. One problem with companies these days are the consumer is getting weaker. So when there's banks have an issue with the consumer being weaker. They don't pay their bills and they have to declare bankruptcy, but MasterCard and Visa don't have that problem because they don't they're not the ones taking that risk. It's the credit card issuers, which is the banks. But they do MasterCard and Visa do have the problem with the global economy slowing. So we'll have to watch for that. Okay, Tesla. You can see that it's actually, if you go back a year, they're like in a sideways pattern. They're at the bottom end of its pattern right now, um, of its channel, and looks like it's in a sideways pattern too, very similar to Apple. So they're in a sideways pattern, and they're oversold, but they're still overvalued. We mentioned that a couple weeks ago. So they're probably multiple times, they're trading multiple times more than um, they're worth. So let's look at one more. NVIDIA. You can see this is very similar to Apple. They haven't gone anywhere in a year. So they're in a trading range. So it seems like whenever they go down to around 108, that's the bottom of the range. And when they go up to 150, that's the top of the range. Until there's a little bit more clarification regarding tariffs and demand for their product going forward, it seems like they're in a trading range. This is one of the most undervalued stocks. We just went over it earlier today. Um, Eli Lilly, another growth stock that's in a sideways pattern. The bottom of its range is around 725, and right here, and the top of its range is around 8 940, 950 right here. So it looks like a lot of our stocks are following into a sideways pattern. So um, until the stock market is fairly valued, it seems like that's kind of what's going to be happening. Okay, here's another one. It's Novo Nordisk. It is in a super downtrend. They are the biggest drug company in Denmark, I think, and they're in a super downtrend. But I thought it'd be interesting to go over this stock. They're oversold. Um, they're a stock that sells. They're a company that sells weight loss drugs such as Wegovy, and they have a lot of drugs in development. We'll look at the financials a little bit later. Let's look at the stock screen for this week. I have three stocks that I thought were interesting. One is we've been following Google for a while. Basically at a fair value. They're trading basically at a PE around nine. Wait, where's their PE? Their PE is 16, and they're growing at around 16%. So they're fairly valued, and they're at a pretty decent trend line. They're at a good spot in their trend. Let's look at it. Missed it. There is Alphabet. Um, this goes back. I went back 5 years for this chart, just so we can see the nuances of every major. You can see that they've held their moving average for multi 5 years, and it isn't until right now they're just basically a little bit below their moving average, but they're still within a channel, their 5 year channel. So this is an example of a stock that's a compounder. That's a stock that continues to go up 14% a year. Now it's fair value now. In a sell-off, it could go down to 100 or maybe 90. In that case, it'd be 20% off or 30% off. So it's really good to know where the fair value of a stock is, if you do have a sell-off. And um, let's look at Novo Nordisk, which is, let's see, it's for long-term growth is 19%, and it's expected to grow 17% for the next couple of years. And their PE is around 16. So let's look at that one, and we'll look at another one. It's called Block Inc. They make the Square um, product, which allows small businesses to run credit card transactions. And they do the Cash App, which is a very famous, um, very useful for sending money between people. And Let's look at Novo Nordisk. You can see their market cap is 341 billion. Their forward PE is 19 and their PEG ratio is around 1.17. So according to Yahoo Finance, they're around 17% overvalued right now. Their profit margin is 34. That's three times better than what we're looking for. And return on equity is 80. That is seven times better than what we're looking for. They have total debt of 108, 102, and total cash of 26. So they have around 70 billion in debt. That's not a whole lot for a $341 billion company, but it is something to keep in mind. And I guess one thing I'd be looking for in a report is how they're paying off that debt over time. Their free cash flow is 61 billion. So they can easily pay that debt off, if they wanted to. They probably got a good interest rate on it. That's why they're probably keeping it. Right now, they're investing in manufacturing for their products, such as Wegovy. They can't make enough of it right now. Let's look at their earnings estimates. Novo Nordisk is expected to grow 22% in the next year and 13 and 15% after. So their PEG ratio then is 0.86. So they're around 14% undervalued according to that calculation. The positives are they have one of the most popular weight loss drugs in the world, and but they can't make enough of it. That's one big problem. They can't produce enough, and they might be affected by tariffs. We'll see what happens, and they had a failure of a weight loss drug in their pipeline, so they don't have a whole lot of momentum. It seems like Eli Lilly's drug is more effective than theirs too. So I guess they're counting on some of their new drugs to help them out in their earnings. And let's look at what Morningstar and CFRA says. Morningstar said that their fair value estimate is 86, which is a little bit more than where we're at right now. Right now they're at 76, so that's 10% undervalued. And CFRA says they don't have a fair value. Sometimes they don't have fair values for companies that are a little harder to understand, such as foreign companies. CFRA said the underwhelming results from their new drug trials for they raise concern about its long-term competitiveness. So the market's going to be looking at their upcoming drug trials, including those for this new drug name. So, okay, so they're going to be trading off of these new drug trials, how well they do, because it seems like they're losing market share in their weight loss drug. They had a first mover advantage in Wegovy, but Eli Lilly is actually it's expected to do better because it's more effective. So okay, let's look at another one. Let's look at Block. Their market cap is 37 billion, which isn't very big. The forward PE is only 13. That's a really small PE, and our PEG ratio is 0.59. So Yahoo Finance thinks they're growing around 23% a year. Profit margins, 12%. That's the bare bone what we're looking for. And return on equity is 14%. So they match, our bare minimums for both of those. Um, they have their cash and their debt. They have basically no debt if you balance out their cash and their debt. And they're making at least 1 billion in free cash flow. That's really good so far. Um, let's look at their earnings estimates. They're expected to grow 22%, 22 23% a year. So their forward PE is only 13, growing at 23%. The PEG ratio is 0.6. So that matches exactly what Yahoo Finance came up with. It's not every day that we have a good match like that. That means it's 40% undervalued. The fair value of the stock is $101. So they're trading at $61 now. Their fair value is 101. Some of the positives, some of my best stocks that I own right now, my favorite stocks are Visa, MasterCard, um, stocks that have like a transactional um, fintech, I guess is the word I was looking for, fintech stocks. And this is a fintech stock. They have a very popular Cash App program for app for the phone. And the one issue that they have is that they are taking um, some, they have some possible exposure to lending losses. So they have a product that allows you to borrow money. Pay now, wait, pay now, wait, buy now, pay later, kind of an app. So because the economy is weakening, there might be an extended amount of losses in that, and that might not be in the numbers yet. So as the economy gets bad, you're going to have, for the companies that allow customers to borrow money, they might not get a return on those kind of investments. Let's look at um, the chart of the stock. You can see it's in a sideways pattern, like Apple, Google. I mean, a lot of the other big stocks we're following. So going back at least a year and a half, one, one, at least 2 years, it's been in a sideways pattern. So it's at the bottom end of its range right now. It's oversold. So it's a good timing to buy it. Whether or not it's going to do well in our environment. Let's look at the tariffs. Are they affected at all by tariffs? It doesn't seem like it because most of their activities within America and they don't have products that they sell that they import. It's basically fintech. So they're kind of isolated from a lot of the tariff issues, but they're still affected by the global economy and slowdown of the US economies. All right. So let's look at what CFRA and Morningstar say. CFRA says that their fair value is 92. So that means they're undervalued by 10%. And the CFRA says the new oh one the newly elected Congress appears to be the most pro crypto, creating a tailwind for their Bitcoin exposure. So Block also as they have a portion of their cash reserves in Bitcoin. So as the price of Bitcoin, maybe they're down right now because the price of Bitcoin is down. Enhancing a they might have a lending risk. That's what they said. Afterpay is what their product is called. Square loans and Cash App Borrow are ways the customer can borrow. And okay, we expect the planned integration of ecosystems, Square and Cash App, could make it increasingly difficult to manage risk, especially with more visible pressure on existing sellers. Okay, so this could have problems with if the economy does go down and and the customer is more fearful and doesn't spend and has losses and they can't pay back their loans, this could falter. So that was a good exercise. All right, so that's all that I had to say for today. I hope you enjoyed that, and I'll see you next time.